You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I'm Bill Powers, and joining me today is Joe Mazumdar of Exploration Insights for our quarterly check-in. Joe, welcome back onto the show. You always give excellent commentary on what's occurring in the mining space regarding mergers and acquisitions. There have been several in the last month. As you analyze what has transacted here, what do you think is the best deal and why?
Well, thanks for having me again. And I've looked at several transactions that have happened recently. I think the GT gold one in Golden Triangle by Newmont, where they acquired the copper gold asset for $365 million. There was First Majestic's acquisition of a private company, which was Jarrett Canyon, basically for a roasting facility and an underground mine. And then there was Grand Columbia basically finishing off an acquisition that they were thinking about doing last year when they acquired Goldex Mining for the Tora Peru, I think it's 5 or 7 million ounces, or sorry, about 10.5 million ounces of low grade in Guyana. And then Evolution Mining with the Battle North acquisition, which was formerly the Rubicon company, and the F2 deposit, which was a debacle, going from 3.3 million ounces in 2013 to less than 1 million ounces now. So out of those 4 recent M&A transactions, I would sort of put forward that the one that made the most sense would have been the Battle North acquisition by Evolution Mining. And the reason I say that is, potentially they didn't buy it for the asset, which has had its issues, but potentially more because they want to control a big district. They're willing to pay $275 million to control it, but also they get a plant that's permitted at about 1.8 thousand ton per day plant there. And so I think that's more of what Evolution's strategy is, to lock in a bigger scale footprint in the Red Lake district and also gain a plant. So for me, that one probably made the most sense. But all I was going to say in my thesis, what I wrote about, and is on our website for anyone to get, is basically that a lot of these assets wouldn't be in my top 10 of acquisitions. It wouldn't be like assets that I would think about, oh, that one's going to get acquired. None of these would have been on them.
From a Battle North shareholder's perspective, was it a good deal? 50% premium?
Yeah. Yeah, because it was like, you have a 46 whatever percent
over the 20-day. I think it was like 53% over the 20-day.
Yeah, and the thing is that because of all the history of operating and then going into the financing, it's best to give it to somebody else. And I think from the Battle North shareholder perspective, it was good. Because as we've seen with Pure Gold and their recent operation results, and the dilution that they've taken, and the head grade wasn't what they thought it was going to be. If you could get acquired early, that's probably a better thing for you, especially with a junior.
Okay, on the topic of getting acquired early, there's Great Bear Resources, which has been flirting with $1 billion market cap with no resource, but excellent results over the last 18 months to 2 years. With a company like that, when you think about the Lassonde curve and how value is created in the early stage, if you're a Great Bear shareholder, do you want them to sell the project at this point while there's still mystery of how big this could be?
It's done very well. When it started, I guess there's 2 sort of assets that it's working on, 2 sort of geological models. One is sort of like the Red Lake Greenstone Belt sort of gold mineralization, which was the Dixie Limb and the Hinge Zone. And I probably was more reticent on that one in terms of, could this grow? Could they connect the dots? I think most of the value right now, which is I think about $650 million US, is on the LP fault zone, which has got multi-kilometers. It's about 18 kilometers. They're sort of looking at 4 kilometers of it. And, that's shallow in spots, so potentially open pittable, and to show consistent grade over that area, like, 100-meter intersections of 2.6 grams, that sort of thing is very good. And so to put that together, is great. They've been going for such a long time with a lot of meters drilled. I think they're going to drill another 175,000 meters in 2021. So the obvious question is, well, is there a resource here? But from a shareholder perspective, hey, if you could drill another area, beyond the 4 kilometers that proves up another area, would that be a better use of money? Because then you could say, oh, it could be X or Y or Z, it could be much bigger. But I think maybe the management team is being pushed on maybe by investors. Maybe they have more institutional investors that maybe say, okay, put this thing together and get a resource. And maybe they're feeling that kind of pressure to actually put something together. They have yet to say when that they put the resource together, but all they're saying now, I believe, is that within the next, month or something like that, they'll announce when they'll put a deadline for a resource. Right now, it's not a catalyst for them, but I understand that investors are looking for that.
But considering there's some deposits out there at the feasibility stage that are like 200 million market cap and you don't have a resource and you're $1 billion, it seems to make sense to me that if you can monetize it now.
Yeah, you don't want to get too cocky about where you are in the valuation. Like ATAC at one point was $1 billion. Gold Standard Ventures in the previous cycle was at about $1 billion. I take you to another project like a nickel project that's in Western Australia. That's a similar sort of thing. Big land package called Chalice Gold, but it's really a nickel project in Western Australia. And it went from discovery to now, I believe it's around $1 billion or more in terms of market cap. Again, no resource, but phenomenal upside. And so from an investor point of view, if I would just start to quantify the upside, but potentially reluctant to say, okay, I'm going to put a resource around it. Because the problem with putting out the first resource, investors say, oh, I was expecting this. Because if they're saying it's a tier 1 asset, Barrick defines a tier 1 assets by giving somebody 500,000 ounces a year over 10 years at a lower half, all-in sustaining costs. And so what the market would be expecting, on that resource to justify, what they're saying is over 5 million ounces. And it's not often that somebody comes out with their maiden resource over 5 million ounces.
Mm-hmm. Joe, could you share a pick with us that you've already delivered to your newsletter subscribers? Where have you put your money recently, just as an example?
Oh, yeah. Okay. So, I think we were talking off air about the last time I talked to you, I was talking about Guatemala.
Yes, you shocked me with that one.
So I'll shock you again.
Okay.
So this time I went to the DRC, to the Congo, Central Africa, and I've been looking at this project for a while. It's called Long Core Resources, LN on the TSX. And I think it's also got an OTC ticker. I think it's LONCF or something like that. It's got about 100 million market cap. I got it for about half the price because I was waiting for them to do a placement, which they did earlier this year. And what they've got is about 2.5 million ounces of resources in a $1,500 gold open pit that's grading about 2.5 grams, which it's in the DRC, but the grade of the resource is about 2.5 times what people are looking at in places like Ontario. And so that gave me some sort of, mitigation for the risk reward with respect to being in the DRC. And also, my idea about the gold price may be meandering now to going lower if the real rates keep rising, then projects like this, given that companies like Barrick, which it has a joint venture on the surrounding land package, are, still making a lot of money and looking to expand, projects like this that are, within a jurisdiction that they're already working may make more sense.
So would you rather take jurisdictional risk over technical risk if you were forced to choose between the two?
I'm never forced. I would say it all depends on the individual asset. Like if there's a significant technical risk, I don't care about the jurisdiction. I would take it. And if the jurisdictional risk is such that nobody will go there, I won't go there regardless of how good the asset is, if it's a fatal flaw. So the fatal flaw might be jurisdiction, which I don't think is the DRC, because we've got Ivanhoe that's working there. We've got a tier one asset in Kamoa-Kakula. We got a tier one asset in Kibale. There's never been an issue about finding tier one assets in the DRC. It's functioning in the DRC. And Kibale is a tier one asset that's produced 365,000 ounces last year, and all-in sustaining costs of 780. And those guys are going big into underground development there. So as long as a big company is comfortable working there, I'm not going to dispute it. And this project's I believe about 200 kilometers away from Kibale. But if I didn't have Barrick working there and they were doing this on their own in this current environment, I doubt if I would have touched it.
What about Banro and the failure of that gold producer in the DRC? How is this different?
I think that was a bit technical, where these guys wanted to build it themselves and ran into issues and then financing issues. My thesis with this company is not that they build it. They just keep growing it, and they've also got the joint venture with Barrick on other ground. And if they get to a certain, resource, size, then it gets acquired. That's basically my thesis with this one. If there's any indication that they're suggesting that they build it, I'll probably pull away.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well-capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
And if you are taking jurisdictional risk, then the management team becomes all that more important to you, I would assume, right?
Yes, absolutely. So in a course like DRC, these guys have been there for decades. So I don't want to really get somebody that just walked into the DRC. So these are people that have found things in the DRC and are quite comfortable working there. And right now with COVID-19, it seems like Africa, or people working in Africa, have a bit of a leg up on most of the world, because they've been able to at least transfer people and work in Africa. They might not have the ability to move expats there, but over the decades they've got enough local people that can work there. And so I found that the companies that I have with exposure there tend to be less impacted by COVID travel restrictions, and also by delays in assay turnarounds with labs.
Okay. Well, Joe, thank you for walking us through your approach to mining and sharing a pick. Let's talk commodities now. You mentioned gold, which many people get offended when I call it a commodity because it's a monetary metal. But what's your outlook on gold for the rest of the year?
Okay, gold's down about 8% year to date, and what I find is it's not really the absolute real rate, which is negative. I think it's negative 0.6% on the 10-year, the Treasury, the inflation adjusted rate. It's really the trend. So when it's going from minus 0.6 to minus 1, gold does very well. But when it's going from minus 1% to minus 0.6, gold can dump, because a lot of what's happening in gold, and has been happening, is the ETF investor demand. And when that comes back, gold, is negatively impacted. And so right now, I still feel that if real rates continue to rise, even if they absolutely stay negative, that would be bad for gold, But what we got to understand is that gold producers in this environment, with gold reserves booked at about $1,250, are still doing remarkably well. We're not in that last cycle where people have gorged themselves on dilutive M&A. We're not. Their balance sheets are much better. They're generating free cash flow. And I think they're in acquisition mode with respect to their depleted reserves. But what's happened is the COVID restrictions has basically stopped people from being able to do as much due diligence as they'd like. So importantly, people working in countries that majors are already, or potential suitors are already in, the due diligence is much easier. And so we've seen a lot of acquisitions in Ontario, where people have picked up, incremental, land like Battle North and Evolution, and a lot of smaller transactions like Agnico's made. And so that's what we probably continue to see as people, take a little bites every now and then. The mega merger thing, I think, is sort of behind us, but I think most of the growth is in the mid tiers, and they will continually look to acquire. And I think some of that constraint's COVID related, but it's not related to how companies think about the gold price or think about how they're sitting financially, which I think is pretty good.
What about platinum? I've read some bullish articles on platinum. Do you like the supply demand outlook for platinum right now?
Okay, platinum's like up about 15%. It's about $12.40 per ounce. It trades, it's almost like a 2-to-1 ratio with palladium, and one palladium is used in catalytic converters, but for gasoline engines, and so does better because there's more gasoline engines than diesel engines, which is where platinum goes into. The other demand drivers for platinum might be, the potential for fuel cells, but what's really pushing the demand right now is investor demand, just like in gold, ETF demand, and that's offsetting the drop in demand in 2020 from, autos, this auto sales. But what's helped the market a lot is the fact that, platinum production, which is, predominantly in South Africa, like in South Africa by itself, dropped about 25%. And so overall, that had a negative impact on supply, which dropped 17%, but most of that was related to South Africa. And so COVID-related electricity issues in South Africa potentially can continue. So there's supply issues that are probably driving the platinum investment thesis a bit. Going forward, there's no doubt auto sales will pick up, and that'll pick up, but that might be offset by maybe some drop in investment demand. So I'm probably more bullish on palladium than platinum, but platinum definitely where it's sitting, has a ways to go. We've seen 3 years of continuous deficits in the market right now. So I'm probably more bullish on palladium than platinum, but having a combination of those both in most deposits is a good thing.
So even with the EV revolution, you don't see the elimination of the demand for platinum and palladium?
Well, here's the thing: is that the EV revolution will take time, but in the interim, you still need to meet emission standards. And the big thing here is that platinum in diesel or palladium in gasoline engines, the intensity, the amount you put in pound per pound in cars is higher to make the emissions lower to meet the standards, because it's going to take a while for the electric vehicles to come in. And some people, like my generation, potentially would prefer a hybrid to an electric vehicle. And so, and that might be something that people do. They just buy the hybrids. And those hybrids, in terms of loading for platinum or palladium, are much higher.
And so that's a good segue. I believe EVs require about 4 times as much copper. So what is your outlook as copper, as it's about doubled in the last 12 months?
Yeah, I mean, copper's like well over $4, and that's a great place for it. A lot of incentive for people to build projects. But what we've seen is that, with copper, is that we've seen some big projects like Pebble being slowed or stopped. We've seen recent issues with Oyu Tolgoi, not only between the partnership with Turquoise Hill and Rio Tinto, with the government, and now with concentrates being suspended in terms of shipping to China. And then underlying that, we got 2 of the biggest producers of copper, which is Chile and Peru, still having issues with COVID. And so that's going to have issues with supply, which it did last year. So from a supply side, copper looks really good. So even if the EV market doesn't penetrate quite as much as some people forecast, on the supply side, people don't know where they're going to get that next pound. And so development projects makes sense right now to feed this market, because if you're going to feed a market that needs copper in 5+ years, you have to know that project now, because there's no way you're going to, just grassroots find a project, develop the resource, start permitting it, and get into production in 5 years for a copper project that would make a significant impact on the market. It just won't happen. And so we've seen issues, like I said, Oyu Tolgoi, Pebble, and even Resolution that Rio Tinto is building in Arizona. So, I think copper is, like, people like to talk about the the demand, the electrification, which is all good. But right now, in the near term, it's as much a supply story.
Mm-hmm. And you don't think there's a technology in terms of engineering developments that could change that quickly? I mean, it's pretty solid, the supply demand outlook for the next 5 to 10 years.
Yeah. I mean, the thing is, like, what do you substitute it for? That's the big thing is copper is very efficient. If you replace it with aluminum you need more volume of aluminum. It's less efficient. The diameter's got to change. It's less conductive, So, people have to look at, what could they replace with it, and what do they lose if they replace it? And copper, even though it's going up in terms of the amount of copper by value that goes into the cars, isn't ridiculous. That's not the biggest cost of the car. So, it's going to be that back and forth. And is there a substitute, going forward? But I think the bigger issue for me in terms of supply is the fact that people are wondering, okay, hey, like China's always got its 10+ year, view of what they need in terms of metal. So they're already, in the DRC, with the Kamoa-Kakula, they've got other projects. They're trying to basically get as many copper projects to their smelters as possible. And now if Biden or his administration passes an infrastructure bill, well, how much copper do you need? How much whatever do you need? And then how do they actually get it? Because we could talk about projects in Arizona, Alaska, Utah, wherever. But all the smelting and refining capacity has gone to Asia over the last 2 decades. So unless they're, really want to secure supply, I don't see how you get that by just making a concentrate and then shipping it to China. So I think some people have to think about, like, where are we actually refining metal in North America or in the Americas?
Well, doesn't my country depend on your country a lot for some of that?
Yeah, but we don't. I mean, we have a couple of smelters, like in in Trail and in Horn, but there's no way that we could take a Resolution size deposit, or even the stuff that might be coming out of Alaska. That's all earmarked for Asia. So I think people got to think about that, not in my backyard sort of thing with respect to refining capacity, and that's what's happening with rare earths. Mountain Pass produces rare earth oxides, but right now, until they develop the refining capacity, they're sending it to China. And then you got to buy it back. So I think to secure the supply chain, it's not just about the mine part of it. It's the whole cycle about getting that refined product that you actually need, whether it's in lithium, cobalt, nickel, copper, moly, what have you. So I think there's got to be a little bit more thought on that's got to come out of, especially in the Americas, if people are talking about supply chain.
Another strategic metal is uranium, which just broke through $30 a pound. And I looked at some of my uranium equities and they were doing good as a result of that. What's your outlook for uranium this year?
Well, I mean, uranium's, I think, up still only about 2%. I mean, yes, it broke over 30. It broke over 30 last year, and a lot of uranium stocks did well. I mean, you're right about, I think it's a lot about, clean energy, zero carbon emissions by whatever 2050. The issue has been, it's not about the demand. The demand is a 2026 theme to 2035 with a growth of nuclear reactors. The issue becomes, what's the incentive for anybody to build a uranium project at $30, even if it is $30, because we really need $50, to make this work. And so right now we need that inventory to be drawn down even more to influence the spot price and then force people to make long-term contracts, because right now most of the market is in spot. It's not in long-term. So I'm still looking for the nuclear facilities and the power companies to start making commitments, because apparently right now, according to, I think it's a UXC, there's 1.4 billion pounds up to 2035 of uncommitted demand. So people haven't signed any contracts for that. So I don't think that's all going to come from spot. So it's really about who's going to make the first move and when are we going to see some long-term contracts. When we start seeing long-term contracts, it's giving you an indication that the inventory has got to a spot where these guys are now worried about where they're going to get supply. And then we'll see the long-term contracts, and that's what people are anticipating, that'll turn the uranium market around.
So you're still bullish uranium, though, just to clarify.
Yes, but it might take a little longer. And my uranium stock, Energy Fuels, is doing well mostly because of the rare earth idea that they put forward, and less so because of the uranium stuff.
Just one follow-up question on that. How soon is too soon to where you're actually wrong? Because as you know, there have been people that have been bullish on uranium for so long, and like the opportunity cost that is lost just having your money there when other, equities underlied by different commodities have been moving so powerfully the last few years.
Yeah, it's all about timing, right? Like, how long do you want to wait? Did you miss it? Right now, as the longer we wait, at least over the last couple of years with the suspensions of, COVID-related, suspensions of production in Kazakhstan. We've had now, there almost seems to be a COVID case in Saskatchewan for Cameco almost every week. And they've had to suspend production off and on. So all those suspension of projects, is at least what it's doing is drawing down that inventory. And that's the key, to drive down that inventory such that it forces the power plants to make the long-term contract. That has taken a longer time because the actual growth in reactor demand doesn't come till 2026 plus. And so even though they won't be signing the contracts in 2026 because they have to pre-buy this stuff, so it's going to happen, in 2024 potentially, or sooner. But we have that, time, and then it's about when do you buy? When do you think when's the best place to put your money in? And again, the reason my uranium company is outperforming a lot of others is mostly because of the rare earth and the diversification. And then also because the U.S. has enacted that strategic stockpile as well. That's helped it as well.
All right, Joe, last question, and thank you for your time. With all the virtual conferences that are offered to investors, and you host one yourself, the Metals Investor Forum, what do you think going forward, now that we've had COVID here for a year? Are we going to continue to see these virtual conferences replace the in-person conferences? And what are some of the pros and cons that you've experienced over the last year?
Well, with respect to the conferences, it's obviously a lot easier to make, and I'm never late for a meeting with these virtual conferences. But the real value in a lot of these conferences, those people that you meet that you didn't expect to meet, that you walk by their booth and goes, oh, that project, oh, this guy, I met him like 20 years ago. That sort of thing, you definitely don't get with the virtual conferences. And so whatever happens, post-COVID, whatever that world looks like, I think people do want to have conferences again. But I don't think that we're going to, we've had a blow up of online conferences because of COVID, and they're easy to put together, and you can have one almost every other week. But I don't see that translating to that same amount of real conferences. There'll be still those real conferences that people will put in their calendar that they want to attend. And I doubt if they'll attend as many as they used to pre-COVID. I don't plan on doing that.
Oh, you don't plan? Oh, confession. Okay.
Yeah.
That's interesting.
No, the thing is that in terms of travel, there's a lot of things I can get done without traveling. I got to make a commitment to travel because, is COVID or any kind of version or variant of COVID ever going to go away? My risk is or anybody traveling's risk is going to another country, finding out a variant, comes up in a different country or your home country, and then suddenly you can't get back. Or, that you were thinking it was going to be, you can go straight through, but now you got to wait 2 weeks, or, there's no flights going through this place that you had an airplane going through before you got home. So the risk of travel is higher, and it potentially will be higher even when everybody's, vaccinated, because not everybody in the world will be vaccinated. So there's risk. And so the risk reward ratio is more. You're not just going to hop on a plane and go somewhere without thinking about all those other risks you're taking. So the conference you're going to, the site visit you're going to, has to be a real high value trip.
That's a good point. It's gonna cause attendance at site trips to go down too.
Yes. I mean, that's what I'm looking forward to is getting back on the site visits, less so the conferences. But you're right. Every trip that I personally will make, it will be more of a risk reward computation than I used to do.
Excellent. Well, Joe, thank you for your updated thoughts. I appreciate you touching base with my audience quarterly. Joe's website, again, is explorationinsights.com, and he offers a very thorough expertise and stock picks to his well explained to his subscribers there. Thank you for coming on today's show, Joe.
Thanks, Bill. Always a pleasure.